this point in time?
So it's been a long journey. I mean, I started in the markets in 1995 when a national stock exchange was just setting up.
Right.
So we started a stock brokerage house. It was like a startup. There were investors in my company, and the conventional startups were not, seen at that point of time. But it was a sort of pseudo startup, and we went on for 2 decades in that business. Somewhere in the middle of 2012-13, I decided to, pursue research and go deeper into non-discretionary ways of investing. Actually, I had seen thousands of investors during this journey of 2 decades who came through our brokerage house, and I found that people were making money not really by choice, but it was happening to them either by luck, or very few small percentage of people had the discipline to actually follow a strategy, and it was more ad hoc in nature, and people would make money in bull markets, lose it all in the times after that. And that the same was happening with my portfolio also. So when I introspected and I said, what am I doing wrong? I make money in the bull market and I lose it, most of it in the bear market post that. So we need to find some structuring to this, where the gains can be saved to some extent, and it needs to have a framework of investing. So having done a lot of investing as well as a lot of trading, I sort of merged the two frameworks. The good part from investing was creating a portfolio, having allocations to 20-30 stocks in that portfolio, and from the trading part was the discipline to have a proper plan and executing it to the T. Having so the framework emerged of 4 questions. What to buy, how much to buy, when to buy, and what to sell.
Right.
So this framework, once it was put into place, that at any point of time, regardless of the market, know where your portfolio constituents are and at what point will you get out. So my focus started to shift towards price-based, volume-based, momentum-based sort of decision-making.
Right.
And I realized that if I were doing fundamental investing or qualitative ways of investing, more often than not, I was getting stuck with the idea that after having done so much research, that you start to get married to the stock, and then when the inevitable thing happens, you start to even get confirmation bias from others, and you sort of convince yourself to hold on, whereas the price is telling you that maybe you should have got out. So from gradually over a period of time, over decades, my framework shifted towards price orientation, price behavior in the market, and that's how these strategies developed for myself. And then post the brokerage journey, I just happened to do this for my own portfolio for a few years. And after the brokerage business, it was getting very lonely, because earlier I had 20-25 people in the team, thousands of clients I was interacting with. And now here I was sitting in my home doing my own thing, not having much interaction with anybody. So I started posting my portfolio on Twitter. And I shared one of the portfolios for a year on Twitter for anybody to follow along with me. And incidentally, that was also a very good year for equities in 2016. And there was a following that built up on Twitter, and I started to be more active on Twitter, and that brought weekend investing into limelight, and we took a SEBI license post that and rolled out the products for others. So that has been the sort of journey so far, and today we serve more than, I think, 12,000 users. So a lot of users have gained with weekend investing in the last 6-7 years that we've been there.
No, absolutely. And wishing you all the very best on the same for your future endeavors as well. Now, as you rightly pointed out, that you've seen many market cycles as well. But yes, market cycle, be it high, be it the bull market, or you could say the bear market, also bring in a lot of stress. So how do you manage stress? At the end of the day, or probably whenever you had a bad day or something like that, I'm sure our viewers would want to know about that as well.
So my journey has been so long that I don't recall after how many years I actually stopped worrying too much about markets, but it took me some time.
It took me.
I think I've seen in last 25 to 26 years most vicious falls, whether it was 2008, whether it was COVID, or whether it was other periods of various stocks, etc. I've seen various strategies going wrong, whether it was pair trading, whether it was demergers, special situations. So all those downsides one sees in a long journey, and the learning is that that I'm not able to. I'm no expert in timing the market. That was my learning for me. Maybe some people are great timers, but my learning was that I am not a great timer of the market. So I should not try to be one. And the fact that one could stay in the market invested, but have your strategies designed in such a way that they take you to cash, bring you into stocks, etc. So over a period of time, every I think person in this journey will realize that markets will give lumpy returns. So this expectation that I need to make money every day, every week, every month, every year, that needs to be tempered and brought back to reality. A great sort of source of confidence comes when you look back into history. I mean, if you go back and study what has the market done in last 10 years, last 20 years, last 30 years. Right. Had I been in that situation, what journey I would have had, going through the market. You would have seen that you would have one very great year, maybe another nominal year, one very bad year, and so on and so forth. So your strategy on how you would have navigated all this over that period of time would give you confidence how you can go forth after that. And I think more than just the equity market, I think a lot of folks sort of discount asset allocation in a big way, because the equity proponents are so strong in their narrative that they will bash other asset classes, real estate, gold, bonds, whatever it may be. Right. And a true investor should have, in my view, a very good asset allocation, because not all assets will perform at all times. And to bring lower that volatility, which actually has a very deep impact on your mental condition and stress levels, is achieved by having asset allocation. There are various assets going up or down at various points, and they counterbalance each other. They are very complementary. So that actually helped me a lot when I allocated a lot of my allocation besides equity to gold and real estate. So I thought that really brought about a very nice smoothened portfolio curve for me over the years. And apart from this, I would also think that unless you are a very sharp trader or a very very professional investor, market should not be your only domain of making money from. I mean, you should have multiple sources of income. Whether it is these days there are so many things to do. You could be blogging, you could be getting interest from your other investments. Right. So various pockets of income should be there, so that whenever there is a downtrend, and there will be downtrends every now and then in the equity market. So to not have your entire boat get rocked because of that one source of income or wealth. So that is something that I've always believed in, and also I think keeping your business and personal space distinct is very very important. So have a good work-life balance. Accept the reality of the market. Accept that every day will not bring you the goodies, and not have fear or anxiety based on this. So seeing the past performance of your strategy or markets in general will give you the confidence that India is in a very very good space. Even now, if you talk about, I mean, we are in a very good space relative to a lot of other countries. Of course, these headwinds from overseas is causing us to be a little flat for the last year. But I mean, nothing is wrong in the current situation as such. So we just need to stay invested. Give the market some time to do its correction, and we'll be off again to newer highs.
Absolutely. In fact, very well said there, Alok. And most of the difficulties or most of the headwinds are basically coming from more external in nature, and they are global in nature. So that could be one of the reasons. Otherwise, what could you advise a new breed of traders, who have just probably joined the D Street post 2020 or post COVID, because the Demat accounts have actually shot up, especially after the 2020 or March 2020. You could say that. What would be your advice to them as well?
So my sense is that if you are very new to the markets, And if you are also working, maybe you have a job, maybe you have a small business or whatever you may be doing, don't leave that. Let that continue on the side, and you should train yourself in the markets on the side, just like any other profession, like maybe an artist or a professional. It takes many years to you to hone your skills and get that grasp of that profession. So to expect that you will jump into the market and start making money from year one, and that may have been a case for you, because we had a great year in 2020 or 2021 post COVID, but that is not the norm. I mean, the market, what we are seeing now is actually the norm, where you actually need to either find value picks, or you need to find momentum somewhere and struggle to make money. Easy money is never the norm. So my sense is that unless you are in a situation where your income or your confidence on the markets is such that you are sure that you will be able to replace your regular income from your job or whatever, don't do jump into the markets. That is for sure. And secondly, I think it's a great profession where high intensity activity is there. A lot of noise of news and media and all kinds of data comes to you 24/7. So to absorb all that, not get your mindset should not get wavered by all this that noise that is coming to you. So you need to have a very focused, sort of a Zen-like situation in your mind, that this is what I set out to do, this is my investment plan, this is my strategy, this is my model, and whatever is happening around me, I will not get dissuaded from my path just because somebody else tells me this stock is good or that stock is bad. It should not matter to you, because you are on your path and you need to go forward on it. A lot of times what I see is that people will try something for 6 months and that strategy may not work, and then they'll give up and try another thing, and they keep jumping like this for years together and not becoming an expert in any type of strategy because of that. So my sense is that strategy is a very small part of this success in the market, maybe 10, 15, 20%, not more than that. Right. The major part is staying in the game, having money management, doing position sizing, doing risk management. That is the key, and the longevity of how long you can sustain this, because market is very lumpy. Like if you see in the last 20 years, you may have had 4 years which were really good, maybe 10 years which were normal, and 4, 5, 6 years which were bad. So I mean, that 4 years which were really very good should not be the base case that you make in your mind that this will happen every year.
Absolutely. In fact, very well said there, Alok. One should not consider that every year we clear double-digit kind of a year, especially what we saw post-COVID. But nonetheless, I think valuable advice coming there from you. I'm sure our new breed of traders would take that into account. And you also touched upon, one should be focusing more on owning their skills and rather than anything else. Now, apart from that, what do you recommend traders to do on a bad day? When they probably incur some heavy losses. Because this is something which eventually they will learn. And you have decades of experience when it comes to managing stress on that particular day. But what would you recommend to the new breed of guys? Because the generation is also very different from where we come from.
That is true. We are quite old geezers, and
right.
The new breed is definitely very active, and they want things to be done very quickly. I think expectation about what can go wrong in your trade, that mindset is required before you enter the trade. Okay. So in that sense, the worst outcome of your trade, even of an investment, should be internalized in your mind that yes, this can happen, and so that sometimes when it does happen, I mean, you do take it in your stride that yes, this was a possibility that I thought about, and in this trade it happened. So each trade should be seen as just one small component of your entire journey, where you don't focus on any one trade. So if you see your entire journey, it will be thousands of trades, and what you need to do is to make sure that you sustain and you are able to live through, to stay alive, to witness those 1,000 trades. and any one trade should not, rock the boat and throw you out of the game. So it's just like eating a meal. You are maybe having 10 bites. So each bite is not so important by itself. It's just part of that chain of things that is going on. So when you are taking a trade, and let's say you assume that maximum I will lose is 2% on this trade or 1% on this trade, or you made rules like if I have 4 losing trades in a day, I'll stop for that day, or some other rules where you will have some cool off period. Because the question is that even if you have a proper strategy and you can maybe are expecting maximum, let's say 5 or 6 losses in a chain of trades, your mindset your mental level may not be the same when you tested it out on paper, in your back test or anything, versus when you do it in real life and actual money is getting lost. So you need to really train your mind when you're doing your simulation also, that yes, if it is going to be actually like this, then what kind of a pain or a dopamine impact will be happening to me. And it is all about discipline and training your mind. I think not putting any emphasis on each trade is most important. So once you take a trade, one should forget about it, because you already know where you will get out, where you will get stopped out. Stop looking at it. A lot of folks I know, let's say doing investments or trades which don't require any action for let's say a week, but they are looking at the market on a micro minute basis. What is the requirement? I mean, if you are not going to take a decision for the next 1 week, what is the point of looking at every minute in the market? You're just increasing the noise level in your mind and creating doubt about your own strategy, as the prices will remain volatile and move. So according to your strategy, you should look at the market. I mean, if you're a long-term investor and you will not do anything, till the next quarter results, there's no point sitting in front of the screen and watching trades and and making your blood pressure go up and down and that.
No, absolutely. And any sort of books that you would like to recommend to traders?
So very frankly, I'm not a great reader. I don't believe in too much of reading, and I believe more in experiencing it and then implementing it. So all these momentum strategies that I did create, they were all out of my experiences, how price is behaving. So like the BPC principle, we say Bhav Bhagwan Che, is something that we follow, that the price is leading and everything else is getting incorporated in that price. All news, all expectations, the market expectation, the inside news that is already incorporated in that price has already been incorporated, and following price itself is good enough. But having said that, I did read Turtle Traders, Ed Secuta, Jesse Livermore, Michael Cohen, several of these books during my earlier formative stage, which allowed me to become more of a trend follower and a price follower on that front.
Right. Well, on that note, thank you so much for your time, Alok. And that's all for now. But do stay low on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time.
Thank you. Thank you so much, Hitesh. Thank you. Bye-bye.